Hello and welcome to everyone. This is Behind the Markets, your online edition, and we are prepping to go on air. Remember that Behind the Markets is powered by Zanaco, and we thank you all for joining us today. I am your host, Munyumba Mutwale, and we are in the fifth year stretch of Behind the Markets. We want to thank as many of you for continuing to join us and continuing to support us and continuing to click in to the show that gives you the best in trends, data, analytics, expert analysis on markets, on financial markets, business markets, and many other financial related issues for you to be able to make portfolio and business decisions about. And this is the best way to wake up and the way to get informed in the right way. That gives you the credible base to make the decisions that you need with your money and with your business and potentially even with your career. So once again, thank you very much. I will be hopefully in time joined by my co-host, Mr. Dominic Davis Chifumbe, who will be coming with me who will be taking a journey with me about how markets are doing. But for now, to everyone, it is Thursday where we are going to be taking a journey through markets as usual, market opens, touching on some of the stories. Some of the major stories coming in, some of the expectations that are happening through the week, and also simultaneously, obviously, when we are going to load shedding stories part 2, what has been happening, especially to the business sector, and also finally, we're going to be tramping into something I'm looking at because I'm talking about 10 trends of branding or personal branding that you're going to need to pay attention to, especially in 2023, looking at some of the trends that had occurred last year and things that we're going to be looking into this year, especially if we're looking at careers and business. I want to really look at how to make money, but I want to recap on those 4 money skills later. But let's first open up, as we usually do, with our look into the markets. Now, we start with our Forex market, and we see the Kwacha has continued on its 63rd day of losing value. I'll say this again. It is the 63rd consecutive day that the Kwacha has traded lower, or the US dollar has traded higher than it did. So 63 days of consecutive loss of value of the Kwacha. This is the second longest running streak. Remember, the record was still up until mid 2021, which was a 200 plus day record set, unfortunately, the previous administration, and it actually led to a lot of currency loss. It wasn't a sudden shock one, but it moved us all the way about 3 Kwacha. This one has been very vicious because it's moved in quite a huge quantum in a very short space of time, and there seems to be a lot of momentum, which does not seem to be getting curbed. Now, this is a huge inflation risk for our country due to our import dependency as a nation. So we really have to pay attention as to what this is going to mean and what this can potentially do to us financially. We do just really want, as I said, want to pay close attention to it. But we have seen that the Kwacha has closed at 18.1978 on the interbank rate as of yesterday. And now it's getting towards, and it's 1.02% up from last week, 5.80% up from the previous month, and 0.56% just during this first week of the year. So we're getting very close to all-time highs. The Kwacha is actually trading very close. To its all-time highs and also to its 52-week high. So we should actually be really, really careful as to where we're stretching on this spectrum. Currently, we're trading just about the acceleration rate, even of the currency itself, is starting to pick up pace, with the 200-day moving average also trending upwards. I think that's the big signal for me, that the 200-day moving average is trending upwards, along with the trading line, showing that the technical momentum of the actual dollar is getting stronger and stronger and stronger. It's one of those strong dollar runs. Dollar has actually been one of the strong performing assets right behind gold. If you're looking at what to store your money in. Now, versus the Rand, which is also equally as interesting because of our import dependency on South Africa, we did see that the Kwacha closed at its 1.0827 Kwacha per Rand. That is 1.8% up from yesterday. So we had a case of a strong dollar, but we also had a case of an even stronger Rand. So remember, the Rand has been starting the year off by getting stronger. The Kwacha is starting the year off by getting weaker. That is actually creating a lot of problems for people who want to import things from South Africa. And therefore, import costs or import dependent costs in South Africa are going to create some sort of internalized or some sort of winds of inflation that might be able to come in from the beginning of the year. So I'm pretty much seeing that the first 2 months of inflation of this country will probably be a bit higher than expected, mainly because of the exchange rate weakness that is going to happen in the first part of the year. So we will probably start to see this reflect in import costs more than anything. But at this weakness of our currency, exports of agriculture might continue to have a good run. And exports in general, non-traditional exports usually have a good run whenever we have a weak currency. So the export sector of the economy might actually start to experience growth right off the back of this. So that's off the FX news that we're picking with inflation risks for the consumer, but with export pickup. So remember, look out for those stocks on the stock market that are dependent on exports. They will probably start to reflect a first half of the year, which might have, or at least the second half of last year, going into a first half of this year, which might have quite positive figures because of their export activity. Now, let's take a look into the bond market. Our bond market has continued to pick up. You did see that the bond market's up about 0.09%, while the GRZ bond in USD are up 0.01%. So we are getting positive movements even in our bond market. Though it's still negative on the week and on the month for the bond market. And obviously, in the year, we have actually seen that even the GRZ bond market itself has started to pick up a little bit of steam. So waiting for the figures to actually do a little bit stronger, we are predicting that we're probably going to see a continued strength in hold to maturity bond trading as opposed to bond investing that'll carry through the end of that. As opposed to bond trading. So it's better to hold your bonds in the meantime, buy them and hold them throughout an auction than to invest in them and for the purpose of trading them in and out. Let's see if we can have Dominic finally join us. Dominic, how are you doing this morning, my brother?
Good morning, how are you doing?
Good morning, Dominic. It appears that we are getting a little bit of a clattering with you, but at least a little bit of you is better than nothing at this point. Good, my brother. It's just wanted to do another check. Are you okay? Can you hear me clearly? All right, fantastic.
Absolutely, I can hear you. I don't know whether you can hear me. It seems like Zuckerberg didn't want me to be part of the stream yesterday.
It appears so, but we have overcome and we shall overcome. Thank you very much for joining us today. And this is me and Dominic. And Dominic, I'm just doing a roundup of the markets. So let's continue where we were. We were seeing about interest rates on bonds are still sitting at about 23.66%, which is higher than you're seeing on the composite bonds for trading of hold to maturity bonds from auctions, where the composite yield is about 21%. So we are seeing that there is a lot more to gain from buying them on the primary market than from trying to trade them, because you might experience the loss-making side of the bond sector. And finally, just to check the commodity markets, we do see that oil has continued its slide downwards. Oil has opened up today at 78.01. So we are seeing weaker numbers in oil. That's very good for us because remember that we use oil for import for energy. So the weaker, the lower the price of oil, the better it is for our economy. But also take into consideration that the lower the price of oil, those oil stocks or OMC stocks such as Puma might actually take a little bit of a beating because higher prices help their current inventory become worth more. So they often try to hold on. They often try to now make more money off that, and lower prices might actually affect their current inventory become a little bit worth less. So you have to look at what that's going to do for that. But liberalization of the market has still been very good. But what we're seeing so far is that year to date, oil is down about 9.2%. Copper is down about 1.43% year to date. Most of this is driven by China. News of rising COVID cases in China has actually created a problem amongst the major commodity markets, and therefore you are seeing slumps in oil and in copper. Those are two major things you want to pay attention to as we're doing that. But gold, on the other hand, gold is still up about 0.7% in dollars, and in kwacha up about 0.99%. So that combination of the dollar movement and the kwacha movement is keeping gold as a very good opening asset. But this is very similar to last year and what we were seeing. So let's take a look at data quickly on the market. That's leading us to all of this. As you've seen, first, we want to just pick up on some of the major news stories. Asian FX muted as market waits Fed minutes. So the Federal Reserve is going to release its minutes, and then we're going to see what direction they're going to be going in. Inflation drives Britain's record Christmas grocery sales. So there was huge spending happening, but unfortunately, most of it was just due to price movements upwards, not really purchasing of more activities. U.S. inflation has not turned the corner yet. IMF's Gopinath, the IMF chief economist, Ms. Gopinath, has actually pointed out that she's not comfortable that we can start doing victory dances over the U.S. The U.S. Over the U.S. inflation figures. And President Biden worries over China's COVID response after the World Health Organization questions Chinese data. I remember people being called conspiracy theorists for saying some of the data was not that great. Now, all of a sudden,
Yeah.
the World Health Organization and President Biden have now woken up to the idea that maybe some of those figures may not be altogether correct. But anyway, that's life. And we're seeing also also,
Yeah.
and we're also seeing some of the other data that we're seeing here is there has now been opening of an international bank to become the first foreign bank to trade bond futures in China. That's how much China is actually opening up its bond market. So that's a big story that came out yesterday. But obviously, the biggest one has got to do with Chinese data coming out and the BOJ to raise forecasts of key inflation gauge. Now, this is serious here because if the Bank of Japan starts raising its inflation forecast, it can potentially start raising its interest rates. And if it starts doing that, remember what I said yesterday about one of the biggest trends is that Japan is one of the biggest investors in fixed income markets around the world. And if you start seeing Japanese interest rates going up, then you start seeing a lot of money coming out of the developed economy. Japan buys bonds from the UK. Japan buys bonds from the US. Japan buys bonds from the EU. They buy bonds everywhere. So what tends to happen is that if Japan starts to fail out or starts to experience higher interest rates, then you start to see credit being moved out of those countries, which forces them to start to move credit out of lower income countries such as ourselves. And therefore, we have that trouble of trying to get them to return to our bond market to strengthen our currency or to keep them in our bond market to keep our currency from coming down. So that's some of the news, Dominic, in terms of the major stories. We are also looking into data from yesterday. Remember, we always do our data dig. So our Wednesday, our midweek data dig yesterday, we were looking at quite a bit of PMI data and import prices. German import price indices are down 4.5% month on month and 14.5. They're only up 14.5% on year, meaning that inflation has really been coming down in Germany. Spanish PMIs and services are up higher than expected. CPI data coming from Switzerland is showing a slowdown in inflation as well in Switzerland. Composite PMIs in Italy have picked up. Have picked up a little bit, but are still in negative territory. With composite PMIs in Germany, same thing, also picking up strength, but also in negative territory. And European PMIs are also strong, but also in negative territory. Let's take a look at mortgage data coming out of the UK. We have seen that mortgage approvals are down from 57,000 to 46,000, meaning that approval for building homes has started to come down. Mortgage lending is up, by the way, from 3.5 billion to 4.36 billion. Remember that it's also a function of higher housing prices. So it's not just really the amount of buildings that are being constructed, it's the cost of the price of the houses that have gone up. And net lending to individuals has also gone up from 4.5 billion to 5.9 billion, also as a result of higher prices of the assets leading to these. The mortgage rates in America have gone back up, ironically, from 6.34% to 6.58%. That's a little bit of a head fake that has turned around on what we were thinking earlier. We were seeing mortgage rates coming back down, but it appears it's turned the course. And obviously, there are a few things about inflation. Everyone is still a bit worried whether inflation has truly been defeated. So we are seeing some slowdowns in mortgage lending in America. So slowdowns in mortgage lending in the UK, slowdowns in mortgage lending in America. PMI is picking up, but not so strong. And the rest of the data we're seeing is that PMIs in America also came in weak. You did see ISM manufacturing PMIs also coming in a little bit weaker as well, with crude oil inventories higher than expected as of the US. So we're seeing also excess supply. That's also what's pushing oil prices down. So if we're looking at all the data from yesterday, what are we seeing? Energy inflation risk coming down, inflation in the supply chain inflation coming out of Germany and the EU coming down. Industrial PMIs have picked up, but housing markets are slowing down. So we are seeing mixed reads in industrial. So when we step back and look at our four horsemen, what do we see? We see slowing down inflation. So therefore, imported inflation risk is really low. We're seeing interest rates still hovering at lowering rates, except for those mortgage rates. I think that was a little bit of a mixed read. So we got to keep an eye on that. While we're also looking at industrial data, which is picking up a little bit in strength, but the housing market, which seems to still be a little bit soft. So housing is the anti-read for industrial data, but manufacturing data, except for America, also is starting to pick up. So we are getting a little bit of a positive read, while growth data is still on the slumps. So what are we seeing? Slow growth. We're seeing an outlook of global slow growth, but also slowing down inflation. So, slow growth and slowing down inflation leads to tactics where we should be looking at high cash flow assets. That should be our main target: high cash flow assets. Because right now, if you're looking at stocks, it's dividends. If you're looking at bonds, it's inflation sensitive, just so that you can curb out that inflation risk. But you're looking for income there. This is why I think for the meantime, even out of that 3 to 5 year pick, you might start leaning slightly towards that 5 year, because that 5 year might start speaking to you in terms of cash flow. Remember that a 5 year coupon has got a percentage higher than a 3 year coupon, and even the percentage return on investment is still about 0.3% higher. So it's as though you'll start leaning slightly towards that 5 year. If you're still holding 3 years, mix the two. That's kind of the strategy that we're looking at for now, and that's what our news is telling us from a global perspective, and also just in general as we're looking out at things. So we're going to take a step back and take a break a little bit, Dominic, as we go into our quick news break. Our break for our sponsors, and we will return on the other side, looking at a few major stories domestic, and then get into the story on personal branding. Back to you, Dominic.
Absolutely. Beginning in personal branding on the other side, let's just get it from us. Remember that being market is actually powered by Zanaco. The number you're using for contribution is 077-1616290. That's 077-1616290. And simply at the push of a button, you to us right here on this very platform. Amazing stuff. I'm super excited for personal branding. Let's get to it just after this word from our sponsors. We're back. Thank you so much for tuning. This is Behind the Markets on Money FM 93.7. A lot has been looked at. If you missed out, remember that we are on LinkedIn, we are on our Twitter, we are on our Instagram, as well as YouTube. So all those platforms are meant for you. Also on our website, www.moneyfmzambia.com, as well as the Money FM app, which is found on Google Play Store as well as Store. So now let's get into personal branding, like when you mentioned it earlier on. Just as with it, I'm super excited about it. Brand new year, I think we should focus more on just starting out with personal branding. At the end of the day, our name is what will help us grow our businesses going forward, and just the way we do business.
Exactly, Dominic, exactly. So this is actually the Forbes top 10 personal branding trends of 2023 for both employees, and also for people who are running businesses. So things that you should consider when going in. So personal branding tips, the top 10 personal
Yeah.
branding tips. I'm going to go through them one by one over these next 20 minutes or so. So let's try and flex out and see what this is. Number one, the emergence of post COVID leader with coaching built
Mhm.
on a foundation of emotional intelligence. So that's something that we've actually stated now, that a lot of coaching services or a lot of the people who are in work hierarchies must now start to express not just only the regular standard intelligence in terms of situational intelligence and professional intelligence. They need to have a lot of emotional intelligence in order to be able to read and lead people. Yesterday, I watched a video from Patrick David, who actually talked about a conference he had done with a few millionaire business owners, and he had asked about loss of days to conflict problems. And he had found that the average business owner was losing 180 days of productivity to conflict. Okay, so the inability to negotiate people properly or to manage them properly from an emotional perspective leads to a lot of these prolonged conflicts that are happening in workplaces. So the first trend that you're seeing, especially out of COVID, especially when it came to online work, is that the emergence of the post-COVID leader is one that is able to coach people not only from a technical perspective, but also with emotional intelligence to understand what people are feeling, but what they need, what drives them, and how to stimulate them to get to work on things and to also do things they believe in. One of the reasons, Dominic, this is really important is also because in that during this COVID period, a lot of people had a brush with life, with the duration of life. And I think there's a question here. I think quickly on that. I'll try and get back to that issue on Japanese bonds. And what that means specifically for the bond market, but we'll just quickly go through this thing on personal branding. A lot of people, Dominic, had a brush with death, and because they had a brush with death, or they saw themselves losing a lot of people who they loved, because of that, we had a tendency of people who started to question things from a meaning perspective and not just from a money perspective. I know that when we're young, there's the arrogance of youth is that we tend to just say, oh, life is all about just money, 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 money. But when you sit down with a person who's in their 80s, now heading towards the final resting place, it's not money that's the issue, it's meaning that's the issue. It's, did they live a life that had meaning in it? Did they actually do things that had meaning in it? And that's only something that can really sit well with you. And that kind of near death experience of a pandemic moving around that was wiping out so many people had actually woken up people to that idea of asking, am I supposed to be here where but the things I'm doing have no meaning? When people just lost these jobs that they had treasured so much because they never realized that a pandemic, something you can't see, can just waltz into their country, shut down their businesses, and maybe the business they were working at just says, right, we're no longer hiring, go home and never come back. And now they have to question their lives and say, I mean, that was it. I was giving myself to something I didn't even truly believe in. So there's this need for people to now start addressing things with also a certain level of emotional intelligence. I'll give you an example of myself from the perspective of investment advisory services. Investment advisory services have always been mathematical for most people, where we just sit down and tell people this stock, that stock, buy this bond, buy that bond. The trends are going this way. That's the right one. Catch it this way. Return on investment will probably be this much. So therefore, go after that. That's all good and well. But if you don't speak to the emotional motives, because what we had to understand was that people had motives for investing their money. Otherwise, come a pandemic, they'll just spend it, they'll just liquidate everything, go and spend it and say, you know what, life is short. I'm just going to try and spend it away. So there must be some form of leadership with emotional intelligence that actually allows for that. Now, that doesn't mean we all sit in circles singing kumbaya all day. That's not what that means. Okay, I know some people try and create that way. Oh, you have to get in touch with everyone's feelings. That's not what that means. That means we have to understand that human beings are primarily emotional beings that make decisions from an emotional perspective. I always say this, Dominic, that we know this
Okay.
because 95% of the
Yeah.
marketing messages that we push out there are based on emotions. That is the reality. Human beings make decisions on emotions. So it's very important for a person who is in any form of leadership, guidance, or advisory. So if your services are guidance, leadership, or advisory oriented, or your role in an organization is leadership, guidance, or emotion, just know that a lot of people are now being driven strongly by their emotions during this period, not in an irrational sense, but mainly because they've actually seen the fleeting the weakness of life, that life can just poof vanish in front of you. Young people gone. A lot of people have been gone, have gone through this period. So a lot of people have started to learn to look at life a little bit differently, and it requires those who are giving leadership services or leadership roles to understand the emotional component. So in terms of personal branding, you really want to brand yourself as the master of emotional intelligence to be able to read that. So it's also a very important thing to be in tune with it. Like I said, it's not a kumbaya circle where you're trying to show people how emotional and sensitive you are. You just have to be intelligent to their communications and be able to read beneath the words and to actually see what's driving them as well. So it's very important. This is why that book, Emotional Intelligence, is actually quite important, people. If it's gonna be a key role. The second the second trend that we're seeing in personal branding, especially from a business and from a occupational perspective, is that LinkedIn will continue to get personal in response to rapidly dissolving line that separates work and life. So this thing of being able to work from your home, this thing of also being able to drive your business from social media, your this blend is now creating a very blurry work life situation. So LinkedIn is going to have a lot more personalized things. I think we've all been seeing LinkedIn is no more just about your CV posted up. There's content. We're even going live there right now. So to all of our LinkedIn audience, thank you very much. You'll see that LinkedIn is now becoming a lot more is now trying to become a lot more personal service as well. So you are able to communicate a bit more of your feelings. You are able to converse a bit more, going live a bit more. So you can see a lot of personalized features. And the thing is, LinkedIn doesn't want to get left behind. So even video features are going to improve probably for those who are trying to make or trying to do business or professional services, even such as myself. We should be looking quite a bit at the LinkedIn audience, but making sure that we're attacking that content with as much veracity in terms of our video and our personalized touch. So personalized content on LinkedIn will also be as important if LinkedIn is going to become more of a personal experience because of that blurring line between work and life. Mainly because we've been working from home for so long that work and life have now just become one. The third trend you need to start looking at is the company, and this is if you're an employee, but I want you to think about this as a business owner who has one. Your company needs you to be the voice of the brand with external constituencies. So companies are no longer trying to only look for celebrity brand ambassadors. I think this is that whole thing of celebrity brand ambassadorships. It's cool. You will get celebrity affiliations and endorsements, But the leaders from their businesses, they're looking for the leaders to now be more of the brand ambassadors. So if you're looking to rise to CEO, or if you are the CEO of your own business that you started, you have to be its brand ambassador. So you have to learn how to manage your social media platform. You have to learn how to speak to the rest of communities and societies on it. This is why we're seeing in a lot of companies, you're seeing managers and certain roles, and even the rise of the what I call the celebrity CEO in Zambia, where you're seeing the CEOs of certain banks, even Zanaco as well. You're seeing the bank CEOs are becoming more active on Facebook. They're becoming more conversational. They're sharing inspirational messages to public people. They're trying to grow their following because Elon Musk has taught us something. No matter how wacky you want to call him, and we can talk about what's happened with Tesla and everything over the last quarter, uh, but he has proven that you don't need a huge marketing budget if you have a popular CEO on social media because he's just able to post the latest thing on Tesla and it's already out there. He's able to post or tweet something or say something. So the question with us is when you're running your institutions. I mean, if you even take a look at Mrs. Fumbeshi, she does this as well. She's also worked very hard on pushing herself out there to be a CEO that's seen out there. You'll even see it with Mr. Fumbeshi when it comes to Fair World as well. You'll see the same thing when it comes to pushing himself out there. You'll see the CEO of Zanaco as well, Mr. Besangondo, also has been putting herself out there. So you'll notice that there is a lot more CEOs out there, and there's countless numbers of them who have been putting themselves out there into the market so that the rest of society can see them as the leaders of the institution, but also so that the institution doesn't have to expend as much on marketing. It actually does help to do this. When you have well-known CEOs in society who maybe have written books or so forth. And I'm also even seeing this not even just from the CEO role. I'm seeing this from other people who have become faces of institutions. Okay. And I'm seeing it even, I've seen some insurance companies who have got members in there who have written books now, who are now public figures now. I've seen some fellow asset managers who have assigned some of their people to go out there and be social influencers while simultaneously working in an asset management firm. I've seen this happening. So there is a trend picking up here. So if you want to elevate in an institution or elevate the institution you have built, you must learn social influence. So learn how to influence people through social media. Learn how to market in social media. There are books on it that have been written, even here in Zambia, about social media marketing, selling yourself as a brand. Personal branding is going to be important. Take courses on it, work on it, but you are going to have to learn how to become a personal brand so that you can become the voice of your institution. And that will give you the credibility to either raise your institution or rise up in the institution if it's not one that's owned by you. So that's a third trend that we're seeing, and that'll allow you to communicate, whether it's communicating to the public at large, to the customer base, to the government. Once you become the voice, you get a lot of power. So you have to understand there's now a lot of power in voice. Okay, so whoever is the voice of the institution, not just the face, the voice, the one that controls the wording of what comes out, that's going to be the dominant voice, the dominant power position of any institution. So if you are an aspiring CEO trying to pick up your business, you're going to have to learn personal branding in this time because a lot of people also, by the way, this is what Neil Patel, the famous digital marketing expert, had actually said, people are tired of faceless brands. So you're going to see a lot more go lives happening, a lot more pictures. And what they expect to see is people in front of a camera, somebody in front of a camera who is synonymous with that brand, constantly talking about that brand and leading that brand will lead to engagement and connection. So that's what we need to start looking at, engagement and connection. So get in front of a camera, people. If you're not great about it, we're going to have to all learn to start doing it. Even I have to keep doing it as well. I can hide behind the numbers and the text and the smart Alex stuff, But at the end of the day, I still have to get in front of a camera to be able to even do that for my own institution, my own corporation, and everybody's doing that. Go to any of these pages I've pointed out to you, whether it's Mkwandi Chibesakunda, whether it's Mrs. Fumbeshi, whether it's Mr. Fumbeshi. Go to them and go to their pages, and you'll just start to notice that they're putting out a lot more content and pictures and sayings, and they're engaging a lot more with people. Why? Because they understand that this is a trend that's picking up, and therefore somebody has to lead with the voice. Okay, even I have been advised to do it more and more. So that is a trend that you're looking at. The fourth trend you need to start looking at is that you must master the modern meeting, and that includes having a hybrid of in-person works with tuning in remotely. All right, so that's a serious thing we all have to understand. Um, in person is important, yes. In person is extremely sorry to everyone who has caught me on a laughing point, but we have had a comment here by Victoria Changa who has said camera, not camera. I did not. Yes, we will tell everyone not. I did not say camera, but yes, people, camera, not camera. So get in front of the camera. Oh yes, so I do say it that way. So camera. Now let's get it back to the fourth one. In order to master a lot of work that you're going to need to do, you cannot be illiterate to online and physical hybrid meeting systems. You are going to have people who are going to be out of town who are still needed in meetings. So the excuse of, no, this one I'm out of town, that's gone. People can patch in now. Okay, so having meetings with everybody there is really important, as opposed to, no, this one is out of town. Only the government can get away with the PS is out of town conversations. We, the rest of us in the business spectrum, must make sure that when we have meetings, we patch people in who are not able to maybe travel, to ensure that those people are there and part of the meetings as well. So it's quite important to master the art of having hybrid physical plus technologically linked in meetings. So if you don't have a method by which you are doing it, you need to master it and have a policy in your company and have the paid accounts, people. It's all good and well to have the free accounts, but you really need to start looking at the paid accounts, because it's now a way of doing business. Okay, yes, it's a bit of a cost, but they really have been competitive about how to bring the cost down. It is a way of doing business. So please, people, let's actually get very serious about that. The fifth trend, above it, let's just go back. Let's just backtrack a bit. Number one, the emergence of the emotionally intelligent post-COVID leader. Number two, LinkedIn is going to become more personal, so more of the content must be more personal. Number three, the brand needs to have a person who's working for it as their voice now. So either the owner or a key employee or a lead employee must be the voice. You must master the hybrid meeting. And number five, personalization of the employee experience, with the new mantra of work when you want, where you want, how you want. Now, this is something that's a bit controversial, because a lot of employees left to their own devices start doing all sorts of things when you give them too much freedom. So there's a balance here, in that the employees' experience of their job and the people you have hired, the experience of their job, must be customized now. Must start building towards their values and their goals and their aspirations. That is true. That is something that you want to start doing. However, you also want to draw the line on making it too much of a free environment, because there is work that has to be done. There is delivery that needs to be done. There's a lot that needs to be done. So I think we all have to focus on how to kind of balance giving people more of a flexible working environment, but not an all-out free-for-all working environment, because this is a tough conversation to have. So you, as a business owner, and even the business managers, you're really going to have to sit down and say, how do we give people more flexibility? Because they've just gotten used to this idea of working at home. Those of you who have had the freedom to do that, how do we give people this flexibility without compromising our operations? without compromising our output to our customers. How do we do that? And how do we personalize this work experience? Is it our selection criteria to ensure that we are connecting with people on values and therefore we can trust them a bit more? Because a lot of workplaces maybe realize they cannot trust their employees because their employees don't share their values. And when given the freedom, they're not going to pitch up for work and do anything. Okay, so that's part of the problem that maybe some have been facing. So there are questions about this whole thing. So these are these are the first 5 trends. Please, people, give us some of your thoughts in the comment section, whether you're joining us on Twitter, whether you're joining us on LinkedIn, whether you're joining us on Facebook, YouTube. Give us some of your comments on this as to what your views on some of these personal, these top 10 personal branding trends that are picking up. Now, and please, I'd be greatly interested to those of you who are viewing in right now. Shout us your comments. Which one has stuck out to you? And I'm going to go through the next 5. The remaining 5 of them is this one, and this one I think strikes very strongly with employers. In person takes priority, meaning you should maximize the time you are actually with people. Okay, virtual has become a convenience. Wonderful. Cool. Everyone says that. But in person still. Almost every sales expert, every sales trainer, everyone who's an HR man has actually pointed out that in person is still a priority. And I'm going to explain this first. Yes, the R's and L's just caught me for a second. I'm going to just recover from that one. I'm going to explain myself very carefully on this one, especially to the younger people. Your first mentors in your work environment or in your career, even in your business life, are going to come from your workplace. The more you are working virtually, the less you are exposed to these people, the less they can do for you, the less they can guide you, the less inclined they are to have conversations with you about things that will open up, the less they will let you meet people. So the people who suffer the most from not working in person, it's not the older workers, it's actually the younger workers who think they're having a lot of convenience, but they're being removed from the networking opportunities of work and therefore what actually builds their value. Most of my value in my young part of my career came from the fact that I would sit down on trips with my boss who would tell me stories or give me clues or give me this. Or when I'd go for events, she would introduce me to people. Or even in my other workplaces, my other boss would say, "Hey, Munyumba, here's somebody who works for such and such a company, and that person I'm now doing business with." Okay, so you gotta understand there's an importance when you're young of actually being in the presence of elder employers or employees, because they're able to mentor you and connect you, and that is where the value of your salary, your brand, and everything starts to build up. So your network will fail to grow if you are cooped up. Okay, especially when you're younger. Especially when you're younger. So for those of you who have really just entered the workforce during this pandemic, you've got to be rushing back to the workplace. I'm telling you this right now. Right now, it seems convenient that you're not at work, and it's okay and it's fun. In 10 years' time, when your career is not moving fast enough because you never got to shake hands with the people you should have been shaking hands with because of anything, you will feel this pinch. And it'll affect even your business life going forward, because a lot of your connections that you're going to use are going to come from those early days of your business life. I understand the temptation and the lure of being virtual the way through, but there is an importance, especially when you're younger, of trying to take in person. So you've got to prioritize in person. Even those of us who've gotten used to consulting virtually, it has been a problem. I will admit to it too. And even this year, we've put a policy in place to try and now open the doors more to in person. It is much more important. In person is coming up, even from my business perspective, and everyone in person. You're even seeing me these days splitting Money FM between being in studio and out of studio. Okay, and you're seeing me more and more coming in studio because it's important. So in person takes priority. I want as many of you to write that down. That's trend number 6 in personal branding. And also there's an element to in person interaction. Number 7 is the quality and focus are key to being seen on social media. So you can get a return on your communication on your communications investment. So the quality of what you put out and the consistency of what you put out. So you really have to put this one out. Quality and consistency of personal branding is extremely important. So I've seen it as well. My personal page, I think we moved from 1,000 to 7,000 last year, and I've just been strictly doing finance and investment stuff. But there was more of a consistency that started to happen on my page that grew it from 1 to 7,000, and that consistency is what I've seen and what I can point out to as many people. Sure, there's tons of formulas and techniques and tricks and tools and everything, but I think all of it just boils down to consistency. Being consistent with your social communications and interactions, and also community building has been very important in that way. So quality of what is coming out, and also the consistency. Quality and consistency does help reap the rewards in terms of your social media investment, in terms of the time investment, and also the monetary investment that you'll be putting through. Number 8 is that feedback sometimes gets forgotten in the digital space, meaning that you need to proactively seek feedback very carefully, constantly look for data, analytics, and also just interact with people to get as much feedback as you can. And number 9 says, as the hybrid employee, your communication needs to be hybrid and multimedia. So you need to start learning to communicate in video, in audio, in written, in various platforms. Having a singular method of communication is not going to cut it. You're going to get lost very easily in this time, especially where there's hybrid work happening around and a lot of hybrid interactions. So you are going to have to learn how to communicate in what we call 360 level of communication during this time. This is going to help you as you're doing your personal branding as an employee, and also personal branding as a business owner. And finally, relationships will rule. So even though virtual connection is harder to form, they are more important than ever. Right now, the number of relationships, or not even the number, the quality of relationships that you are able to cultivate, even if you have a small following of 1,000 people, but if these are intensely engaged 1,000 people, it is better than the person who has 100,000 likes on their page or 100,000 follows, but when they post, no one says anything, or let me just put it so, or no one sees anything, no one cares, no one interacts with them, they're not engaged, they're not bought in. So you're better off having a smaller, more intimate, but highly engaged group of people than people who are just going straight for than people who are just the numbers of people. So really, quality of these relationships is extremely important. And quickly, we're just going to end on that note. Those are the 10 branding things. I'm going to share them. I'm going to share them on my page for everyone. We've got Chinsoko Musona, who has said, personal branding will be good to be able to sell yourself and the products you want to be in the market. Exactly. People they first buy into you before they have bought into before they've bought into before they've bought into your product. Victor, your English went to private school. Thank you very much. All right, I think we'll leave it from there. Thank you very much to everybody. Sadly, we could not have Dominic with us because we're still having network issues there. But I hope you had any takeaways. Please feel free to post. Give us your favorite of those personal branding tips, those trends. Give us the ones you'd seek help on. We'd love to connect you with professionals who may be able to help you, because the more you communicate with us about maybe some of these trends that you might want to see or might want to implement in your personal career or your path, then the more you'd be able to actually get someone here, an expert here outside of just me, but somebody who's in this personal branding space. Remember, look for somebody who specializes in areas, not just somebody who generalizes. I can give you general information as a practitioner, but they are specialists in this area who eat, breathe, and sleep these. Seek them out. It's very important as we go along. So with that, I'd like to wish everybody a wonderful Thursday. To all the entrepreneurs who are hearing that out, I'd like to wish you all. I would like to wish you all a wonderful Thursday. Mr. Prince, I will address that question first thing in tomorrow's show. I will note it that it should be the first question that we should address before we get into the markets, where I will explain why is it the Japanese bond interest rates are pretty important, and I'll also give you a recap on what we talked about yesterday in terms of mega trends on the market. But with that, I wish everyone a wonderful Thursday. Thank you very much to everyone who has joined us. God bless. Finish the week strong. And remember, in these first 90 days, momentum, momentum, momentum. The momentum you build in these first 90 days in your business, your life, and your money are going to carry you through to the rest of the year. So don't take these 90 days lightly. They're really important. With that, have a wonderful day.